Good afternoon, viewers. It's your tutor CPA Charles Cafe, and today we are going to look at the simulation 5, and it's under IS 36, impairment of assets. We've been talking about this impairment of assets from the start. Of course, we tried to look when we were in IS 16, IS 20, IS 41, and others. We tried to look at the impairment of the asset, but now we are going to talk about the practical computations that are going to help you understand and appreciate the theoretical aspects that we discussed in our first video that introduced this standard of IS 36. And since from the beginning of this video, we made sure that at least we try to make you remember some of the items that we are going to be dealing with. And I wanted to first give you a precursor of what we discussed from the first video. That was the theoretical aspect that was highlighting all the items that are going to be covered within the IS 36 impairment of assets. But here we are going to be looking at the key terminologies that are used within the IS 36. We try to look at the measurement. When we finish the measurement, of course, measurement of impairment loss, we shall look at how we can account for revaluation gains and impairment of the asset. Scenarios whereby in the first year we had a revaluation gain, but in the next year the asset is going to be experiencing an impairment. And of course, we shall look at the impairment of cash generating units, those where we determine the where we try to look at how these cash generating units are going to be impaired. We try to look at some of the things that we can't estimate their value in use and how we can be able to determine their impairment. So the last part or the last bit of the standard, we'll be talking about the reversal, of which the reversal of impairment, where maybe we had an impairment first, then in the preceding year, you find that the asset is going to be having a gain or is not going to be impaired. So those are the things that we are going to be looking at. But as far as computations are concerned, we are going straight to the measurement of the impairment, and we try to look at some of these ways how these assets are going to be impaired. And basically, when we try to look at some of the key terminologies that are used within the standard, and we said what is impairment, we need to first know what impairment is. We need to know the value in use. We need to know the recoverable amount. We need to know the carrying amount, because those are the figures those are the terminologies that we are going to be using as far as when we are doing computations for this IS 36. So impairment is basically the fall in the value of the asset so that its carrying amount is higher than the recoverable amount. Actually, what this means is that when these assets are going to be less, if let's say the cost or the amount we have in the balance sheet, that is the carrying amount, is higher than the amount we can actually get from the asset. And the recoverable amount, actually, if I may start with the carrying amount, carrying amount, we said that is the value in the balance sheet. It's not all the same that the carrying amount is going to be the same as the net book value, because when we're doing financial accounting, that is level 1, we try to look at the net book value in a sense that it is the cost when we have less the accumulated depreciation, and that was something that was giving us the net book value. But in this paper of financial reporting, I want us to deviate more from that aspect of saying that carrying amount is always the same as the net book value, because in this financial reporting paper, you find that some of the standards are using different models. Like in IS 41 uses fair value, uses cost model and fair value. So you may find that the actual figures that are going to be in the balance sheet for someone who have actually used the fair value is going to be different, either fair value or the revaluation model. So when you're talking about the carrying amount of any asset, we are talking about the figure that we have in the balance sheet. It's not going to be that all the time the company is going to be using the cost model, so that we get the cost minus the accumulated depreciation. So I hope you can be able to get that difference between the carrying amount and the net book value. They are somehow related, but there are some bit of differences as we specified. So that's basically the carrying amount, the value in the balance sheet, or the value of the asset in the balance sheet. Then the other one is the recoverable amount. These key terminologies are very important because we are going to be using them interchangeably. You will find that if you don't talk about the carrying amount, you may find we are talking about the recoverable amount, because we are going to talk about them until we finish all the computations that are within the standard. So it's better you get them from the start. And for those who need more clarity on them, make sure you try to watch our first video, because we took time and we explained everything because we knew where we are heading. So the recoverable amount, of course, the standard defines it as the higher of the fair value less cost to sell, and that's basically the price to be received from the sale of an asset. But that price, we look at it and we less the cost that we are going to be incurring. In other words, it's what we are going to be receiving from the market after deducting what we incurred to make that sale. For example, if let's say you wanted to sell an asset, maybe a computer, but you get a broker or you give to this sales agent, you pay them a commission. That commission is supposed to be deducted from the amount, whichever amount you are going to be receiving from the sale of that laptop, and what remains there is actually what we call the fair value. Then the fair value less cost to sell. Then the other item is the value in use, because they are saying it is the higher of the two. The two items, we have the fair value less cost to sell and the value in use. Value in use happens in a sense that if at all you are not going to sell this asset, if at all the asset is not going to be sold and you are going to use it in the business. So we are trying to look at what is going to be the amount we are going to be generating from the use of that asset. Remember, we only recognize these assets when they can transfer economic benefits to the entity. So since they are going to be providing economic benefits in terms of money to the organization, we try to look at what's going to be the amount that we are expecting to receive from that asset for different years over its useful life. So we try to look at that figure. That is the value in use, or the actual amount we are expecting to receive from the use of an asset. So that amount, since that amount is going to be in the future, we need to discount that figure to its present. And how do we do that? Of course, we get the discounting factor that will be given the question. We discount that future sum of money and we make it present. Because the reason why we are making that figure present, because we want to compare it and we make sure we record certain figures in our financials. That's basically what actually we are going to be looking at. So if you want to know the impairment loss, whether the asset has been impaired, you compare two things. You compare the carrying amount of the asset, and you also compare the recoverable, you compare the recoverable amount. And we said the recoverable amount is the higher of the fair value less cost to sell and the value in use. So we can now try to look at the question and we see what the question wants us to get. This is simulation 5, and it's basically we are trying to look at the impairment of the asset, or the impairment loss. And we said impairment loss is just a fall in the value of the asset where the carrying amount is higher than the recoverable amount. So we are saying that the machine has a carrying amount of 900,000 and is estimated to generate cash flows of 220 per annum from year 1 to year 5. Its fair value less cost to sell is 660,000, and the discount rate is 15% per annum. Then the question says determine whether the asset is impaired or not. So this question says determine whether the asset is impaired or not. What that question brings to whoever is going to be solving the question, you get two things. Of course, you have to first explain what impairment is before even you do the computations, because we are trying to narrate, or we are trying to explain to people who don't have any accounting background. So we need to first explain what happens if someone says that the asset is impaired. You need to first of all narrate what happens, or what do you mean by impairment. Then from there you can try to put in the figures so that someone can be able to get exactly what impairment means, and they can also be able to make a decision whether to sell off those assets, whether to do whichever information they wanted to do with the asset, depending on what you have actually computed as the outcomes. So let's try to look at the solution. Of course, I gave the answers, we gave the impairment, and we gave the recoverable amount. But this was just a guidance for someone who actually first listened to our audios, the theoretical aspect, so that when you are going through this question, you know, if you don't get these values correct, you find that you have to rewatch the video again and be able to understand so that you can solve these things out. But for now, let's try to look at how we can be able to solve this. So before we compare these values, of course, we said when you are determining whether the asset is impaired, we have to first of all know the carrying amount and the recoverable amount. So that's why I'm saying before we compare these values, we know that the asset is impaired when the carrying amount is higher than the recoverable amount. So now we are trying to look at the value in the balance sheet. If that value in the balance sheet is higher than what we can recover from the asset, then it means that the asset is now impaired. So that's actually the emphasis I wanted to make. Because if at all you don't understand some of these key terms, you may not be able to get what we are going to be solving. And we are seeing that from the question, we have been given the carrying amount as 900,000, and the recoverable amount, we said it is the higher of the fair value, less cost to sell, and the value in use. But we say the value in use, we get it by discounting the future cash flows, and then the fair value, less cost to sell. We said we try to look at, there are certain costs. You may find that they have just in the question, they have just given you because here they gave you the fair value, less cost to sell was 660,000. But in the other questions, you may find that they have just given you the fair value of the asset. Maybe it was 700. And you find that they are giving that the cost they incurred to sell or to realize that fair value, that market price, is maybe 40,000. So when you deduct, you'll be able to get the 66,000. So if you are given this information in parts, you've been given the cost that they incurred to sell these assets, you make sure you first do that analysis before you start to recognize those figures. So they went ahead to say that it is estimated to generate 220 per annum from year 1 to year 5. And those are the future cash flows we are expecting to receive every year. So we need to discount those cash flows, and we'll be able to get their present value. What is if you're expecting to get 200,000 maybe in 1 year's time, in year 1, or towards the end of year 1, what will be the worth of that 220 in year 0 or at the start of the year? Because they are saying we are going to be receiving that same amount, 220, for 5 years. So we are now trying to look at what will be the worth of that sum of money we are going to be receiving in the future today. So that's what we call the discounting, and we shall learn more when we try to go back to check the financial management videos and be able to learn more of what this discounting means. So now we need to know how we can convert these future cash flows we have received and we turn them into our present values. We said we are going to be now, we said there are 2 options. You may go by discounting each cash flow you are going to be receiving every year, or you may decide to use the annuity factor. And the annuity factor is just a sum. It is just a sum of all those discount factors from year 1 up to year 5. It gives you a sum of those discount factors. And we just multiply that annuity, we multiply by that annual cash flow. If at all these cash flows are going to be uniform. Uniform means you are going to be receiving the same money every year for the next 5 years. But if these cash flows are different, if maybe you are receiving 200,000 today, next year you are receiving 220, the other year you are receiving 230, make sure you discount everything using the discounting factor, not the annuity. Because if you use the annuity sums up all the amounts or all the discount factors for those period, and you'll be able to get only one digit that can be able to, and when you multiply with that uniform cash flow, you'll be able to get the same answer as someone who computes for every year and at the end of the day sums up all the figures. So I hope you have actually got that. We are going to try to see how we can be able to convert these values into our we'll be able to see how we can convert these figures, and we see what we can be able to get. So let's try to go to Excel and we try to see what we can do, because it's where we are going to be able to compute some of the things and be able to understand as we see what we are doing. When I open here a small spreadsheet, let's try to wait a bit and we see how it displays, and we'll be able to see what we can do. Can try to enlarge a bit. So we can try to make summary of what we have, because I'm seeing here in the question we have the machine, they have given us the carrying amount. So if they have given us the carrying amount, we can start with that. The carrying amount, we have it. Carrying amount, and the carrying amount was 900,000. I did not put any currency sign because people are viewing from different countries. So you can be able to add whichever currency, whether dollars, whether Ugandan shillings, but I've just given you the figures, and the rest will be upon you to decide which currency symbol to use. But what my emphasis is basically for you to get the basics and you'll be able to do the computations. Otherwise, that's what I want you guys to be getting. So let's also try to look at the recoverable amount. Remember, we said we are comparing two figures. And our recoverable amount, of course, we said it is going to be the higher of the two. Is going to be now the higher of A, we have the fair value. Fair value less cost to sell. Which they gave us as the fair value was given to us. It was 66. Then we have also to look at the value in use. We computed these things when we were doing the first, actually our first video was all about doing these present values. And we said this is going to be the discount, we get the present value. And it's going to be since we are going to be receiving uniform cash flows, we said we are going to be using the annuity factor. We multiply that figure by our annual cash flows. So the annuity factor is got by using this formula. We give these formulas, so don't get scared, because these things we did them when we are doing the first number we handled. So it is 1 minus, we open bracket, it is 1 plus R, and we said our R, that R represents the discounting factor, and we try to divide all of it, we divide by this is to power, it is 1 minus 1 plus R to power n, and n is our number of years. Then when we have got that, we divide the whole thing by R. We said our R is the discount factor. They have given us the discounting factor, so it will be 1 minus open bracket 1 plus R, and our R was given to us as 15%. So it is 15%. Close the bracket, that one is to power. Our N was given to us as 5 years, because they said we are going to be receiving that money for 5 years. Then the whole of it is going to be divided by 15%. Divide by 15%. So when you try to compute that, you'll find that you'll be getting, this was supposed to be negative power n. Sorry, there is a negative here. In the formula, it's supposed to be negative power n. Even this one will be negative 5, power negative 5. So this will be able to give us, 3.352, and that's the annuity factor. We said for us to get our present value or value in use is going to be equaling to the annuity factor, which is 3.352. We multiply that figure by our uniform cash flows. And our uniform cash flows, they were 220,000. So this will give us 737,440. And this is the figure that we call the value in use. I said you put whichever currency sign you want. Let me have taken that one. I've not given it any currency symbol, but you're supposed to provide one. So they told us everything is going to be, our recoverable amount is going to be the higher of the two. Either this, it is going to be either the recoverable amount, which is going to be the value in use. So when we try to look at this, we are seeing that this is going to give us the higher is going to be 737,440, which is going to be our recoverable amount. This is therefore Therefore, the recoverable amount is 737,440, which is the higher. So now what we are going to be doing is we are going to be comparing with the carrying amount and the recoverable amount. We can bring here our carrying amount. And our carrying amount was 900,000. So now, if you try to compare these two values, we can be able to determine whether the asset is impaired. It means that the amount we can actually get from the market is only 737,440. But the carrying amount or the value in the balance sheet is 900,000. It means the asset has reduced in value. And that deduction is what we call the impairment loss. And the loss is going to be the difference between 900,000. It's going to be the difference between 900,000 we less the 37,440. This will give us a difference of 162,560. And this is going to be our impairment loss. That's the figure for the impairment loss we actually got. So having done that, we are now looking at how we can be able to get which figures we are going to be taking to the balance sheet using the subsequent measurement. Because we said when an asset is impaired, the recoverable amount is what's supposed to be taken to the balance sheet. Even if it is lower than the carrying amount, we take the recoverable amount or the revalued amount. And that's basically what we are going to be doing. We are seeing that the asset is impaired since the carrying amount of the of 900,000 is higher than the recoverable amount of 737,440, hence giving us the impairment loss of 162,560, and this can be taken to profit and loss. Of course, this impairment loss goes to profit and loss and is deducted as an expense. So the double entry here, we are debiting profit and loss by 162,560, and we are crediting the asset because the asset is going to be reducing in value. So we can try to write it here maybe. We are going to be debiting the profit or loss account by 162,560. And the other one we are going to be crediting, because here we credit the asset. Credit the asset by 162,560, showing an increase in the what? So showing a reduction in the value of the asset. But in the profit and loss, it goes there as an impairment loss. Here you can add in it goes under expense, but it's supposed to become in the names of impairment loss. So that's it, and that's what the question wanted us to do. But remember, I gave you the first thing you are supposed to first start with here. You start with the narration, explaining what impairment is as we actually discussed it. And that's basically what the question wanted us to do and be able to find whether the asset is impaired. So this last bit of it, you have also to write, you make a comment, because the question was asking to determine whether the asset is impaired or not. So you make a comment that the asset is impaired because the recurring amount of 900,000 is higher than the recoverable amount of 737,440, giving us an impairment loss of that. You explain that, but you make sure you don't be too wordy. Explain something brief, but it can bring out the whole idea of impairment. That's basically what we can do. But in the next video, we are going to also look at the same thing of impairment, but this time around, we are going to be looking at the accounting for evaluation gain and impairment of the asset. And we are trying to look at when an asset that was previously revalued upwards, or which had a revaluation gain last year, but this time around, this year, it is getting impaired. How do we treat that? Those are the things we are going to be finding in the next video that we are going to be dropping very soon. Thank you guys for watching, and urge you guys to make sure you subscribe for this to this channel. We'll be able to get the information that we need, and we'll be able to understand as we also help the channel to grow, so that we can be able to share knowledge. You make sure you comment. If there's something that you didn't understand, please put it in the comment box, and we'll be able, you can try to email me, you can WhatsApp me, and we'll be able to clear everything out, as it will help you understand more and more. Thank you for now. Share these videos to others so that they also get what you have actually got. So it's bye for now, until we meet in the next video that's going to be coming very soon. Bye-bye.